Hello everyone. Well, stocks fell around the globe yesterday, and in the current risk-on equals buy dollar environment, that meant the dollar weakened. A fall in treasury yields also helped to undermine the U.S. currency. Markets all over the world seem to be trying to figure out just what the end of quantitative easing means. Just as quantitative easing was a massive global experiment, its end will be too. One implication of this change for the foreign exchange market may be that the impact of economic indicators could change. Good could become bad, and vice versa, if people focus on what the data means for quantitative easing rather than for growth. For example, recently, stronger growth has meant higher stocks, higher interest rates, and therefore a higher dollar. But that could turn around and mean higher growth means more chance of withdrawing liquidity, which could mean lower stocks, which might be negative for the dollar despite higher rates. So I think you should expect volatility to rise over the next several months as the market ponders this regime change. Now, Eurodollar is recovering somewhat today as the outlook for further easing measures by the ECB wanes, despite the downgrade to Eurozone growth forecast. Yesterday's pickup in German inflation and the acceleration in Eurozone money supply growth makes a further easing next week less likely, even though the fall in lending to the private sector accelerated as well. Plus, opposition on the EC board to further extraordinary moves seems to be mounting. Assuming that the Eurozone confidence indicators due out later today come out higher, as expected, I'd look for a further rise in Eurodollar towards 130.30. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.